Grow CFO is where finance leaders grow together. Join thousands of like-minded professionals using Grow CFO to access the combined knowledge and experience of the finance leader community. You can join us today, growcfo.net. Hello and welcome to the Grow CFO show. I'm your host, Kevin Appleby, and today I've got with me Dan Eyman, who is the Managing Director of Meld Valuation, going to talk all things today about valuation of firms. Where does the valuation number come from when you're going through your Series A, your Series B, when you're heading for an exit? Valuation is very important. Dan is going to tell us all about it. But Dan, before we start, now, how did you get into valuing businesses?
Yeah, good question. Thanks for having me, Kevin. I fell into it. So my original background is actually in cell biology. I was a researcher for 5 years at the University of Washington's Department of Medicine. But in doing that, I decided I didn't want to keep pursuing the world of research and science. It's a tough world. So I went back and got my MBA, and I met my former boss at a CFA luncheon. And when I finally finished my MBA, they offered me a job. They taught me how to do valuation work. And I worked for that company for 5-6 years. It got acquired. It's now owned by Capital IQ. And then at that point, I went and started my own firm. And then that was 11 years ago. So we've been in business 11 years. So I've been valuing companies for a long time, for 16 years.
Yeah. So have you been through a fundraise for your own company, or did you bootstrap it?
No, I bootstrapped it.
Yeah. Avoid the investors.
It's a different beast once you let an investor into your company. And then it even depends the type of investor you let into your company.
Yeah, and it's certainly a view we've taken in Grow CFO up to now, that we've tried to avoid investors and grow in the same way, because as you say, it changes things.
Oh, absolutely. Like I said, it depends. If it's friends and family, obviously they're not taking board seats. Family offices are pretty founder friendly as well. But once you let a VC in, they want a board seat. They want to see certain growth and really will change your company in certain ways.
So where does your role start usually, Dan? What stage do you get involved in a deal?
Most times it's post-deal. Sometimes it's pre-deal on the VC side. So for different reasons, sometimes it could be either an equity investment or a debt investment. They want to see what things will look like or shake out in a waterfall calculation based on the round and the optics, or they want to get some kind of sanity check around valuation. But on the founder side, it's usually foisted upon them for compliance reasons. So it just depends on which angle I'm coming at the deal.
So founder is already talking to the prospective investor or buyer as the deal's going along. Presumably there's already a price on the table. And
typically,
you're effectively auditing that price rather than coming up with the price in the first instance.
Typically, yeah. I mean, we've consulted on fundraisers for founders. It's atypical, I would say, for us. But M&A, there's usually already a price on the table.
So who would you say your client is largely? Is it it's presumably the investor, it's the venture capital house, it's whoever it is that's putting the money on the table?
Yeah, I mean, our clients, what I tell people is funds, companies, and founders. So, and that's for different reasons. We work with funds for portfolio valuation, and then we do what's called carried interest valuations for general partners. On the company side, there's a whole range of reasons why we might work with you. And then for founders, it's usually gift and estate tax work. Founders, they will sometimes engage in a estate attorney to move things in and out, shares in and out of trusts, or gift shares to people or to certain organizations, maybe post-deal. And all that requires valuation work. So
a lot of the time you'd be working directly with the CFOs in these organizations.
Oh, yeah. On the company side, it's always the finance function. So CFO, Vice President of Finance, Controller, sometimes COO gets involved, but usually the CFO is always involved. I've worked with probably thousands of CFOs at this point.
So thinking about that, what are the most common mistakes you come across when you're doing this job?
I've seen it all, the good, the bad, the ugly, the criminal. I think that's tough to answer. The most common, I would say, with founders, it's typically they think their startup's worth more than it actually is, which is where a good CFO comes in. I find when a good CFO because I've worked with organizations when they go from seed stage to exit, names that we've all heard of. And I've seen it when the CFO comes in, it's the grown-ups in the room, and it can bring some sanity, some rationality to the world. But founders always think that their startup is worth more than it might actually be on an economic basis. I guess I would say the most common mistake I see is not bringing in a CFO early enough. Things can get real messy real quick. Yeah. And a lot of times, even if you have a founder who's pretty good at finance, they don't know what they don't know.
Oh, exactly. Yes.
And that's where a good CFO, a good finance function comes in. It's like bringing in the grown-ups, is putting on your big boy pants, for lack of better terms at the moment. So I think that's the most common that I see in terms of finance function, is not being organized enough and not bringing in a CFO soon enough.
So typically you're going to have your around the CFO at that stage, but certainly I would have said by the time you get to the Series A, you would want a CFO in place.
That would be nice. Typically at that stage, it might be fractional CFOs. Definitely by Series B, you definitely, a lot of times at that point, investors require an audit. They require to bring in an audit firm. Most founders have no idea what they're doing when it comes to an audit. Sorry, founders. They're lost. They're like, oh, I need to do that? Oh, man. I can't tell you how many calls I've received from, let's just say, like controller level kind of type people. Again, maybe there's no CFO in the firm yet or the company yet. And what I hear is this: the auditors just told us we need to value X. We're trying to close our audit in a week. I'm like, well, we can do it. You're not going to like the price, but we can do it. To answer your question, definitely once you raise your Series A, bring in a CFO.
Yeah. This is where it becomes real, and transactional finance doesn't cut it anymore.
Absolutely.
Far more at this stage than just simply being able to post the debits and credits, process the invoices, pay the bills, and CFO needs to be on board.
Yeah, cash accounting no longer is acceptable.
Absolutely. Yeah. I'm looking at the PDF that I got from you before we started, Daniel, and there were some suggested interview topics on there. There's one that I'd love to explore with you a little bit.
Okay.
The $1 billion illusion. Why valuations often smoke and mirrors? Why are valuations often smoke and mirrors?
When you see a press release, let's say it's a company's valued at $1 billion, $5 billion, whatever it is, most people assume that the whole company's really worth $1 billion. But in reality, that's often based off maybe the last preferred price on the round, maybe a post-money value, what the investor paid, but the economics aren't equal. Those preferred investors often always have liquidation preferences, usually anti-dilution protection, and other terms that means they get paid before anybody else. So it's called the liquidation stack, right? So you got your A, your B, your C, your D. All those people are getting paid before your common shares get paid out. And what founders and employees usually hold is obviously worth significantly less on an economic basis, right? Yeah. So a unicorn valuation, in my opinion, is an illusion. It looks great in TechCrunch, but it doesn't always translate into realizable value for most shareholders. That's why we say valuations are sometimes smoke and mirrors, because they're financial optics, not economic reality. And I've seen so many valuations. I've done so many valuations where a company is valued at X billion, and then they have to reset their valuation because they're never going to get that in the market. And again, in my opinion, the true test of a valuation is two scenarios: public markets and M&A. What someone will really pay for your company. Look at 23andMe. I don't just pick the billion number, but now someone just bought their data for like 150 million. Same thing happened. I valued Casper. Same thing happened. Tempur Sealy looked at that and went, yeah, we can put a mattress in a box. Eroded their valuation. So it's often just silly, these press releases that say, oh, we're valued at this. It's like, well, we'll see.
Hype has produced the valuation, essentially.
Yeah, or just the last post money, which is just silly because it just assumes all the shares have the same value. And that's not the case. About 65% of the time, common will receive absolutely no value. So in an exit, no one talks about moderate exits or just exits where investors got their money back. The founders walked away with nothing.
And I suppose the other thing is that you've got multiple funding rounds going on, and every shareholding gets diluted. No? Thinking about that, what's the most shocking percentage ownership you've ever found coming out of rounds like that?
I mean, I've seen some really egregious venture rounds as well as private equity deals. Punitive, usually it's in an economic downturn when I'm not inside the deal, I'm not inside the negotiations, but outside looking in, it looks pretty predatory and egregious, but 40, 50% ownership on a round, or multiples on liquidation preferences with participation, meaning when you invest 10 million and you get a 3x liquidation preference, meaning you invest 10, but when you exit, that investor gets 30 million.
That's where you get to the point where the original founders likely to walk away with nothing.
Absolutely. And then on the private equity side, it's pick your deal in which a company has been bought, loaded up with debt, management fees have been taken.
So Dan, with AI on its present trajectory, which businesses do you think are going to be those that are going to see a substantial reduction in value in a short period of time?
Well, I think a lot of the AI companies that are being funded now, a lot of them are not going to make it. This is not the first hype cycle I've seen. I saw it with cryptocurrency and ICOs in the 17-18 era, right? Billions raised on a white paper and a concept. And then we saw a SPAC frenzy in 2021, and that was eroded just by a change in the economic reality. I worked on a lot of SPAC deals, and a lot of those are now down either 70 to 90% or have been delisted. And I think we're in a current hype cycle because I think investors have a bit of FOMO. They have a fear of missing out. So they're pouring money into AI startups, paying big premiums, maybe without the kind of diligence that would be demanded in another sector, right? And that creates a lot of risk. And a lot of these valuations are based on future potential. They're not current performance. But on the other hand, AI is reshaping a lot of industries. A lot of times I tell founders ask me, a lot of times they don't ask me, but you don't need to say your business is AI enabled. It should be implied. So, I mean, I think we're in a current hype cycle with AI startups, generative AI. We're going to see a lot of write downs, a lot of startups that go to zero. I mean, just raising on a concept and then valuations doubling in months. So I've seen it before.
So you're seeing the valuation double in months, but you're going in there and being the auditor of that valuation. So auditors are always on the pessimistic side. What are you looking for then in a company around AI to say, is this something that's solid and is going to stay the course, or this is something that could be way overhyped?
Yeah, I mean, how fragile is the business model, right? Do they have revenue yet? A lot of times when I'm working with a fund, for instance, they have an idea of where they want to carry that value. And I tell them, listen, I'll do my best to get an auditor to accept it. But a lot of times our auditors, and to their credit, are grounded in economic reality. And so they'll make the fund carry it at another value. I'm kind of in the middle. Sometimes when I'm working with a fund, I don't have an opinion. I'm working for the fund. I'm essentially their back office. So, I mean, it's business fundamentals. Do you have revenue? How fast is it growing? What does your cost structure look like? To be valued at billions of dollars and then just have no revenue whatsoever because it's all based on future potential. Seen it before, see it again. Yeah. They often get written down or written to zero.
Yeah, I remember the dot-com boom way back, and all those companies that collapsed back then. It's the same thing over again, I guess.
I believe so.
You must have seen stories so far where a startup's valuation has collapsed overnight.
Oh, absolutely.
Yeah. Tell me about one or two. What are the key things that went wrong?
Yeah, it's typically a shift in the market. So broader economic forces that are beyond their control, or sometimes regulatory changes. Definitely on the biotech side, not receiving some kind of FDA clearance or the trial not going well. Those outcomes are binary. Yeah, it's pretty painful dealing with auditors on the pharma and biotech side because often they think like they ask questions like it's a normal business. And I'm like, it's not. These are binary companies. If they get the FDA approval, the valuation goes like that. If not, it goes to zero. And then I've seen a lot of stories where you have a certain valuation and they just don't hit the fundamentals, or they go shop the company and there's no buyers at that price. They go, we'll buy you at X. And they go, and they have to write it down. Obviously, COVID, people were like, oh, was COVID bad for you? I was like, it was great for business because everybody needed to revalue their equity. I was so busy during COVID.
I guess in COVID, you saw winners and you saw losers.
Absolutely. Yeah. We had companies that just took off, unbelievable growth. And then we had companies that had to reprice their equity half, 75% down. It was an interesting time for sure in terms of my world.
To what extent is that response to COVID down to the mindset and the resilience of the people running the company? You've got a company that comes out of COVID and flies, valuation double, really be in the right place at the right time. But then there's the other company who's halved their equity value. Now, to what extent is that purely down to being in the right place at the right time, or is it down to, do you think, a really good management team who can be visionary, can flex, can change direction?
I think what I saw was the larger forces are what caused these shifts in value. So there was lucky winners, just being in the right place, right time, right business. And then there was losers, wrong place, wrong time. Nothing they could do. It was beyond their control. But then what I saw was the best companies, in terms like for a company that's doubling, tripling in growth, they knew that the best management teams knew and the best finance functions knew this will not continue post-COVID. So like you take a company like Peloton that got way ahead of itself and their valuation reversed. That's like just poor management and it's poor. Maybe the CFO at a company like that said like brought some rationality and the CEO overrid him. And then again, the best management teams that I saw knew that it wouldn't last for the companies that had to reprice their equity down 70%. And they managed costs really well. And they came out of COVID just fine. They didn't have to shut the doors. So I think having the right management team, the right finance function in place is really important and not getting ahead of yourself. The losers are the ones who thought, oh, this will continue. I mean, that's irrational thinking to think your COVID growth will just continue forever post-COVID.
People are going to go back outside and ride normal bikes eventually again.
Yeah, exactly. I mean, it's funny because I'm a cyclist and I saw so many, I don't have Facebook, but my wife does. And I kind of was looking on Facebook Marketplace and you could get like a Peloton for pennies on the dollar after post-COVID because so many people were using them as clothes racks. So
right. Now, we're talking there about the quality of the management team and in both situations, how having the right brains in that company that grew quickly plus the right brains in a company where they had to halve the valuation, knowing that it was all going to end, managing it properly. Now, valuation does tend to be a lot about formulas, methodologies, and so on. To what extent do you think the quality of the management team is taken into account in a valuation?
Yeah, well, what I tell people is that the quality of the management team will show up in the numbers. I have a little Latin phrase over here, in numeris veritas, in numbers there's truth. When people ask me about things like that, I'm like, well, if you have a great management team, it'll show it. I mean, to be honest, I can see it when just in the documents that come through. How clean and organized are the projections or the historical financials? Just talking to the CFO or the vice president of finance, I can tell immediately. Is this an organized team? Is this a good management team in terms of the finance function? It depends. Bigger companies, I'm never talking to the CEO. I'm always talking to CFO. Yes, but smaller companies, I'll probably talk to both. And it's I stopped counting at 5,000 valuations, but I've completed so many valuations and talked to so many management teams that I can tell immediately if I'm talking to a good team or not. And maybe that's a bit qualitative, but I do think it shows up in the quantitative numbers. We've had a number of clients that have been on Shark Tank, the show here, and they'll ask me, oh, is that worth anything? And I say, if it is, it'll show up in your revenue.
And likewise, in the UK, we've got the same show. We call it Dragon's Den, but it's exactly the same concept.
Oh, nice.
And yeah, I've seen many ones on there where things have gone wrong because the presenters just plain don't know their numbers.
Oh, yeah. I've seen the books of these companies, and some of them are good and some of them are disasters. But I think I like Dragon's Den better. I think I like that title.
Yeah. Dan, I'm thinking of putting myself in the CFO's shoes for a moment. It sounds like the quality of the data room that the CFO puts together is really going to make a difference in terms of the valuation exercise. So CFO going into the valuation, CFO will be putting the data room together, giving you the information. Now, what tips would you give a CFO as they go into the valuation process?
Yeah, I mean, typically they're delegating the responsibilities, right? But if they're not, let's say it's an earlier stage company and maybe you have a fractional CFO, but just have organized, clean data in terms of valuation, in terms of financials and your cap table, and whether you use a cap table tool or just keep it in Excel for it to be organized. At the valuation level, I don't need to see every little detail of the G&A expenses, just how much is the G&A expense. We're looking a little more high level than an accountant would, right? But just to be organized. In my position, I can't tell you how many valuation engagements I've done where, okay, we're ready to move forward. Great. Here's what I need. And it takes them 3 weeks to get everything together. You'd be surprised. But, the best CFOs, they're already organized and easy.
We've got the case where it might take them, you ask the questions, it takes 3 weeks for them to get the numbers ready. If they are really prepared, how quickly can you do the process that you're going through?
Depends on the valuation type, but I've done valuations in a day. Those are expensive. Typically, if no one's rushing, I tell people about 10 business days from the time I say, hey, this is what I need to you get your draft report, meaning the way we work is we do our valuation and it stays in draft so we can talk about it. Because sometimes there may be things that I don't know the companies as intimately as a CFO would. So they may say, have you thought about this or have you thought about that? And I said, no, that's a good point. Let's integrate that. So there might be iterative changes, but.
So very much down to not just picking up a set of numbers cold, but there's a lot of this is about forming a relationship with the CFO and making sure that you're approaching this together and you have a good dialogue going on.
Oh, 100%. Yeah. I mean, this is a people business, even though I'm taking sometimes qualitative information and turning it into quantitative information. But it's very much what I tell people is like, listen, anybody can take your financials and put a multiple on it. But what it is taking what the CFO is telling me, the qualitative information and what's going on that's not quantitative, and making sure that's reflected in the quantitative work we do. That's really important. That's what a good valuation firm can do. There's a lot of bad ones out there who just will slap multiples on things or just, you want a certain number, they'll just apply a super high discount that would never fly with an auditor. So it's very much a relationship business, and it's making sure that we understand what's going on qualitatively in the company.
Yeah. So I look at some of the courses we've got in Grow CFO where we do have a reasonable amount about how to value a business. And I know within those courses, we talk about 10 or 15 different valuation methods, potentially. You're talking about a multiple. Do you generally value everything based on a multiple of the bottom line? Or how often are you dropping into other methods?
Depends on the stage of company, the type of valuation, why we're doing the valuation. Later stage companies, you're going to be using multiples, especially if they're profitable. If you're working with, say, like a private equity backed company or you're working with a private equity fund. Early stage companies are probably the hardest to value because they may not have any revenue, or they may have a post. Like I have a client that has a post of several $1 billion, but only a couple million in revenue, right? So how do you make sure that value comes out, that it makes sense? So there's lots of different ways that we value companies. And a multiples, no, it's not always what we use. We use things like option pricing models, lattice models. We may look at venture capital ways of valuing companies. I don't like income approaches only because they're most appropriate for later stage companies that have a operating history. I cringe anytime I get someone else, when I see another firm's work who does an income approach for an early stage company. I can count on my hand the number of startups that have met their projections. So income approaches are not appropriate for an early stage company. And then there's one of my favorite, but it's sometimes hard to get multiples, is just to do an M&A approach. Like, what did other people in that sector pay for similar type companies in recent history? And what do those multiples look like? Because that's real deals.
Yeah. Look at the history of real deals. And I guess there's an element in there that you then look at the risk that's involved in this deal and compare that to the risk that might have been around in the others and discount or otherwise appropriately.
Yeah, absolutely. And why did they buy it? Did they pay a premium because it's strategic? So one of the things we think about in those approaches, is there any sort of premiums or in the multiple that was paid? and why.
So really, if you're the CFO going into this, one of the things you should be doing is having a really good look around the market, looking at similar deals, and I guess setting expectations with your CEO and others around the board appropriately.
Absolutely. If you can get the multiples aren't always disclosed in deals, which is why I say it's one of my favorites. It's hard sometimes to get the multiples. I think if you can look around at recent deals, I think that's a good proxy for what's going on in your industry. I think also if you can talk to investors in the space, what are you currently paying? Where's your head at? But you also have to ask why, because different investors may have different reasons for different multiples they're willing to pay for things. So,
and the founder always thinks their business is worth more than it actually is. What do you think the commonest reason is for the founder to think that?
I think it's just a matter of being human. It's their baby. Everyone thinks their kid is special. I think my kids are the best. So I think it's a matter of just being a human being. And what I find is that founders that have like serial founders, they kind of have like a more rational kind of take on things. But first time founders, second time founders, they may think their company is worth X until they start shopping it. And then they find out, oh, it's not worth $1 billion. It's worth 700 million. Like,
and the fact of life is whatever you think the business is going to be worth, it's what is the other party prepared to pay?
Yeah. I mean, at the end of the day, like I said, my two favorite proxies for really adjusting a valuation are M&A deals and public markets. I mean, what will someone pay for it? But public markets can be a little rational too, you know?
So in wrapping this up, your overall advice to the business looking for a valuation, looking to move quickly on a deal, what are the 3 key things they've got to get right to make that deal move?
Number one, being rational. That's important. And having a reason behind what you're saying, right? So if you say your business is worth 6 times forward-looking revenue, you need to build an argument around that multiple. That is valuation.
Yeah.
Why did you pick the multiple you picked? Or why is it worth X? You have to build the story around the valuation. That's the most compelling piece of a valuation. And then lastly, more of a housekeeping item, just to be organized. I've seen middle market companies that are a mess. I mean, outsourced CFO firms love those people because they're good clients to come in. They need a lot of work, but being organized. But I would say the most important piece is building the story around your valuation.
And as we said earlier, get a good CFO in early. So fractional CFOs listening to this, please use this as good advice to your prospective clients for the reasons they should be employing you, because they're all late in hiring.
Yeah, I'm more than willing to tell companies you need a fractional CFO.
Yeah. Dan, that has been fascinating. A real dive into the world of company valuations today. Thank you for being this week's guest on the Grow CFO Show.
Thank you for having me, Kevin.